Alright, so today we are going to talk about specifically, I had planned something special thanks to today's session. We're going to talk about ideally trade management, but how to make the most out of a high tier trade compared to a low tier trade. Now, this is of course keeping in mind risk reward trades, right? We're not keeping in mind scalps. Scalping is a different kind of mindset when it comes to securing and the setups that you take. When it comes to the large ones, though, we like to do something completely different. So let's go over it. Now, like we know from last class, and ideally from previous, what makes an A setup or an A plus setup is when all the time frames confluence together, right? So you have the hourlies, the mid time frames, 15-minute, 30-minute, 5-minute, and then you have the small time frames for the entry model. If all three are in sync, it goes from a C to a B to an A. And depending on how good the A looks, it can be an A or just an A plus. Now, when it comes to our management of these trades, there's that fear of, oh, I don't know how far price can go, or I don't know if I should cut here because I feel like it could reverse on me any moment. And then there's like kind of like that head smack that we do where, oh man, I should have held the trade. It's going all the way up just like I thought it would. Why am I not in? And you kind of kick yourself for that. So ideally, trade management completely depends on the tier of the trade if you're taking. If you're taking a C tier, you have to keep in mind that for your C tier trades, you want to be very conservative because the probability of success isn't, let's say, stellar, right? The probability of success for a C tier setup is there, for sure, that's why you're taking it, but it's not, let's say, 100% going to work most of the times. And because of that, or it might even work your way for a bit, but then completely reverse on you. So if you see, at least kind of think of it like a rule of thumb. If you see that it's a C tier setup, you want to first aim for the most internal liquidity. Remember the price in a range. Let me just imagine that this is a range right here. So you have point A, point B. So price in a range has internal liquidity and then has external liquidity. The external liquidity will always be the very high and the very bottom of the expansion range that has been made. The internal liquidity will always be the one inside, anything inside that range. Now, commonly with C tier setups, we don't tend to really go for these ranges, the very highs, the very bottoms. We either tend to chop around or we go for internal liquidity first. And if setup tends to work out really, really well, you might even go for the external, but the probability is much less decreased. So, if you have a C tier setup, and let's say we go long right here, let's change the color. Our target should be the nearest internal liquidity, or at least our major scaling out point should be the internal liquidity right there, because you never know if after it hits that, bam, continuation right after, or it's reaching, breaks down, or just simply just chops, doesn't go anywhere. So kind of like a rule of thumb, depending on the setup or the tier setup, you manage differently. For me, C tier setups are the most dangerous ones, so you kind of want to be a little bit adaptive with the circumstances. Aim for internal liquidity. Don't overhold it too much. Be conservative with your risk management, having your stop break even early, not, or let's say moving your stop a little bit wider just in case it chops too much. Those sort of niches. What about a B tier setup? Now, B tier setups are a little bit of both sides. It can go for internal liquidity in reverse, but at the same time, there's a lot more possibility that it may go for the external liquidity and purge it and reverse, or just continue going all the way up. But most commonly, it also happens to run more than a C, and it could, let's say, the difference would be here. Let's imagine we have a fair value gap right here. On a C setup, you're expecting internal liquidity to be wiped and then potentially just that's it. In a B setup, you can expect something like this, and then the setup ends there. Or, of course, it respects and keeps going for the external. the probability is relatively uncertain, kind of 50-50ish on what the outcome might be when it reaches this point. Because let's say 1 minute time frame says yes, mid time frame says yes, but the high time frame says no. What if the high time frame says that we are actually way more bearish because in a 4-hour SIBI we're rejecting it and it's looking like we're simply retracing to a premium to then continue going lower, right? So it's impossible to know if that PD array is going to lead to true expansion to the external liquidity or if it's going to lead to a rejection to continue going lower. With that in mind, you manage your risk. Okay, instead of targeting this internal liquidity, I'm going to target the PD array that matches more with the high time frame, potentially being bearish, to scale out or to exit, because this could be the outcome. Or let's say I do get to exit here, comes back down, I think it still works, I add more here, then I write it back up, scale out more, inverses the fair value gap, goes towards external liquidity. That would be a good managed trade. What about an A+ setup? If an A+ setup appears right before your eyes, it's a given that it's going to take out internal liquidity. You don't even have to worry about scaling out internal liquidity because it's highly probable that it's just going to wipe it all out. Example today. Today we had an A-tier setup, a setup I was confident in taking in my funded trades, right? We said that from my approach yesterday, I was only going to cherry pick the best of the best. And we took multiple trades today. We took several in our evals, but only one in the funded by the time price ran a bit higher. Now you could say, well, Tyler, why didn't you just enter when it was all the way down here? Because it was not an A-tier setup yet. If you look at the high time frame, right? What is confluencing for upside price in high time frame? The 4-hour busy right here. We wicked into it at 10 a.m. We started to respect it. That's a sign of price being in an area where it can definitely pivot from. For what? For continuous highs of 6 p.m. of yesterday. Bam. High time frame says bullish. Hourly says bullish. What about the 1 hour? Came to the 1 hour fair value gap, also pivoted, bullish. What about mid time frame? Now, in that area in specific time, all we had was a pivot from this fair value gap right here. So mid time frame wasn't exactly confluential yet. We only had high time frame to work with. We only had same thing here because this was a pivot, not even a 5-minute CISD. So we literally only had hourly time frame confluence and 1 minute confluence, because the 1 minute gave us the setup that we were looking for in the longs after invalidated the shorts. A nice quick inversion right here and here. So that means 2 out of 3 things are present for an A-tier setup. But since it's only 2 out of 3, that means it's a B-tier setup. It is likely that price will run the internal liquidity that we have right here. It is likely that we're going to reach a specific area where price might then try and pivot back down. What could be that area? Well, it could try and reach a premium. Or, let's see, we can try to find this right here. It could try and reach a premium, or it could try and reach a specific PD array before selling off. Which one do we have right there? The 15-minute SIBI. Okay, so if it's a B-tier setup, it is likely to run all of the internal liquidity and reach the PD array that we have present in this moment right there. So the management for that trade would be obviously your entry, your stop loss, but you can rest assured that there's a good chance that it's coming here, so you do not have to be fearful of exiting fully out here, exiting fully out there, or exiting fully out here necessarily yet. Now there was a point when this was still a B-tier trade that I was, a little bit sketched out. Oh man, maybe it's gonna stop here. Came back down, did an inducement, but by the time it did an inducement, what happened? Price went from just being a B tier to being an A tier. Because we had 5-minute bullish structure, we had a 5-minute stop rate, taking out the low. We had a 5-minute market structure shift with displacement. We had a retracement to the 5-minute fair value gap. Classic 5-minute 2022 model. So now all time frames are in sync. So when it became really sketchy to hold, your B setup now turned into an A setup. So you can technically feel even more confidence that's going to go higher. And that's why, even though I got stopped out at break even here in the first funded trade, I took my re-entry on the inducement because it was still an A tier setup. Now, of course, where is the confidence to hold? I wanted to end my day early, so I targeted midnight, which is an absolutely down target. But I also mentioned that for anyone that was holding, this and this here were going to be the given targets, because it's highly likely that after invalidating the 15-minute CIVI, this would be ran through. So the way that we can kind of manage it, even if you're afraid with a stop, is you trail the stop to every swing low that happens, because ideally the swing lows are manipulation in price. So this is manipulation right here. If your entry was here, you trail it to the swing low right there. Swing low right here, trail it. Swing low right there, trail it. You basically, every swing low that is made, you put right there to try and not only put it in an area where if it were to knife down, and assuming this isn't manipulation that it knifes down, with distribution, it's a shift or it's a potential reversal for price to go the other side. You're already out with a couple of gains, and you don't have to stress out about, oh, maybe I should have held it more, maybe I shouldn't. Now, truth be told, trailing your stop to every swing low can have its risk of inducements, like this one right here. Technically, having a stop here wouldn't have been bad, but it became a risk to an inducement, which happened right there. Other things is, follow along with every invalidation of every PD array. If price is strong, it's gonna run through things firmly. It's not gonna show much respect, but if price is weak or it's failing to displace higher, you're gonna see it struggle with certain PD arrays more than others. That's why for me, I didn't want to go long until it broke through the CIVI right here and inversed it, because this was the strongest point that held price down, even if it invalidated these three right here. Once it did that, I didn't mind chasing, because in high time frame we were still pivoting from the 4 hour, and we still have a 5-minute 2022 model to go for the external liquidity right here. So at any point you could confidently enter here, knowing that it's very likely to go all the way to the external liquidity above. So ideally, for these sort of managements, depending on the tier, you perceive it the following way. C tier, target internal liquidity. Be careful of hardcore rejections, because it's likely that it will get hardcore rejected in a certain PD array. B tier setups, you can target external liquidity, PD arrays itself, and scale out on internal liquidity. A tier setups, you might as well hold it till the external liquidity, in my opinion, because it's very likely that it will strike those things. And of course, you trail the stop. You don't become oblivious to certain things that price does. For example, even though this turned into an A, I was pretty sketched out by Q3. Q3 here did kind of scare me, but it got ran through. As soon as Q3 ended, I didn't care. It was pretty obvious that price was just going to continue going over. And I would say that is how ideally you want to manage these sort of setups. And you want to manage them according to the tier to try and make the most out of it. You don't want to let your judgment or your emotions cloud you and scare you off of a trade that you feel uncertain about if you know what tier it is. Obviously, no blame if you exit a trade early and if it's a C tier, or if I tell you it's like, hey, this is a risky trade. Why? Because it's not an A+, obviously. So if it's a risky trade, you can expect a risky outcome, a risky reaction. Of course, you know, why even bother taking a risky trade if it's not an A? Well, if I enter here, that's 72 points. From, let's say my target was midnight, so it's like right around here. So if I had entered the first inverse, which was the most risky, because it's only an inverse, there's no true invalidation of anything, I would have made 125 points. But if I entered the very confident setup, I would have only made 56 points. So a clear difference is there, obviously. High risk, high reward. But is it really worth it to overexpose yourself to high risky trading your opponent accounts? Well, that is kind of based off it's based off your sizing, it's based on your risk tolerance. Of course, some people would be fine taking it. I wouldn't, because I want to be as conservative as possible. But let's say you're willing to take in your important accounts, then size in way lighter. Add at the invalidation of every PD array that happens so that you can compound a good sizing, And then once it turns into an A setup, you can practically hold it with a good sizing to all the way towards the external liquidity. That's technically what soy sauce does, and why he only needs to win 35% of the time, because he gets that big move going with lots of sizing, and he practically ranks up all of the liquidity in an expansion. Any questions so far? Great. So it was kind of an in a nutshell explanation, because there isn't really much details other than the obvious. Those details being, things that we've talked about before. Being selective, having right risk management, but it really is, you identify the tier, and based on the tier, you have your vote of confidence. Because it's always going to be a confidence thing when it comes to being in a trade and holding it. How confident are you that it's going to go all the way up? I'm super confident you're going to be fine. You're not going to even care. TP, stop loss set, if it hits, whatever, if it doesn't, it's fine as well. If you're not confident, then you get scared, you get stressed, you have to stare at every single candle, you get frustrated at every single reaction, you hover the mouse over the button, unsure if you should exit or not. So, and that also goes to the sizing. If you have good sizing, you don't get too stressed, you don't get too anxious, you're able to hold it reliefly without any single worry. I would say that that's kind of all of the info I do have to say about this situation. So it might just be a short class. There isn't much more to go on over how to really manage an A tier setup, in my opinion, other than keeping those specific facts in mind. I would say, for scalpers though, because there's also insight for scalpers. Since all of this is really fractal, right? All of the time frames are fractal. I would say if you're looking to scalp, use your 5 minute, treat it like in different ways. Use your 5 minute, 50-minute time frame. So use the mid time frame as if it was treat it differently. You treat your mid time frame as if it was the hourly time frame. So you use the mid time frame PDRAs or structure as your bias. You use the 1 minute structure as your structure. So you treat the 1 minute time frame as your mid time frame for the setup, and then you use the seconds for the entry. And that's how you can distinguish the tiers for a scalp. Hitman, maybe we can get him here one day for you guys again, but that's how he would scalp. He would always scalp the 5, 15, and 30-second time frame, because he would have that fractal mindset for it. So it's similar to what I've been explaining, but if you really like to scalp a lot more than taking risk to reward trades, essentially push the time frames down. Mid time frame is basically the new hourly. 1 minute is basically the new mid time frame, and the seconds is your entry time frame. And you treat it the exact same way. But the difference is this: instead of targeting hourly liquidity, you only target mid time frame liquidity, because a scalp isn't you targeting the large expansion. A scalp is you obviously targeting the most internal liquidity nearby, and that's why you kind of push everything at a time frame lower, because you never know if a 30-second setup is going to lead to an actual expansion that takes out external. So internal would be the kind of you go to mostly. All right, gang, do you have any questions? Yes, ideally scalpers do use a lot more different sizing because they rely on smaller targets, but they also have a high win rate. To be a profitable scalper, ideally you have to have a nice system with a good win rate, because since you're having smaller targets, you want to make sure you win more than you lose. With risk to reward, the difference is that, for example, you could have a 30% win rate, but your risk to reward is so good that even if you lose 3 times in a row, one win has you at break even or even in green. And that's why sometimes, even though I get my butt kicked, I always end relatively the week green, which is what matters. We're not here to make gains in one day and then lose it all in a day at the same time. No, we're here to make long-term positive expectancy. Green months, green weeks, not green every day. Well, let's see. Let's see how Asia session has been moving. I feel like it went back to normal. Yeah, it kind of did go back to normal. This time it's a 40-point range. I don't think I will. I think that stream was kind of like there's a lot of volatility and volume, which made it nice, but here we can see plenty of volume imbalances, and I don't want to spend hours staring at the chart in something that doesn't look very appetizing. But you know what? If you guys see a good setup forming, or if you guys think that the price action is nice and you want someone to stream it, you can tag me, and if I like how it looks, I'll stream. I'll try and take a trade. But you guys gotta remember also, you know, less is more. You don't really have to trade every session. You only have to trade the session where the highest probability setups are, or where, like I've been saying, if you open the chart, you know exactly what the market is gonna do. If you open the chart and you're confused and you have no idea what it's gonna do, then why even bother? Oh well, I suppose you guys will know. Once you've been trading for a good chunk of years, you'll see how less is definitely the way to go. Any other questions? Alright guys, so it's a short class, not an hourly class like we've been doing, but you know, it doesn't matter the time that we take. What matters is the quality of the information. So I hope you guys enjoy it, and I'll be seeing you guys tomorrow.